Welcome back, Finan 2020 students. Let's dive into Chapter 17. When most people think about how the Federal Reserve creates money, they picture a giant printing press churning out dollar bills. But the Fed doesn't actually use a press. They use a balance sheet. This table shows the Fed's ledger. Like a bank, they have assets, what they own, and liabilities, what they owe. On the left are assets, U.S. Treasury securities and bank loans. On the right are liabilities, physical currency, plus reserve accounts banks keep at the Fed. When you or I buy an asset, we have to spend money we've already earned. But when the Fed buys a bond from a commercial bank, they pay for it simply by typing a larger number into that bank's digital account. They aren't spending existing cash, they are creating the payment the moment they make the entry. This diagram shows the direct result. Step 2 illustrates the monetary base. It equals physical currency in circulation plus bank reserves. Think of this monetary base as the raw material, the initial seed money the Federal Reserve directly controls. By treating their balance sheet as a master control panel, the Fed governs the financial system. Every time they make a new accounting entry to buy an asset, they directly expand the foundational money supply used by everyone. To actively adjust that money supply, the Fed relies heavily on a tool called open market operations, or OMOS. This illustration compares the process to a water tank. When the Fed buys bonds in the open market, it acts exactly like turning on a faucet. It injects new reserves straight into the banking system. As those new reserves flow in, the total volume of the monetary base naturally expands. If we look at the right side of the image, we see the opposite reaction. When the Fed decides to sell bonds, it takes in reserves from banks as payment. This effectively opens a drain at the bottom of the tank. With that money pulled out, the total monetary base shrinks. While open market operations are the primary tool, there are 3 other ways this balance sheet can shift. The Fed can provide emergency loans directly to banks, they can purchase foreign currency, or people can decide to withdraw cash from their local bank accounts. Ultimately, by actively trading bonds, the Fed acts like a master plumber. They deliberately turn the valve, carefully controlling exactly how much water flows into the financial pipes. But how does that raw money in the Fed's reservoir actually reach your neighborhood and grow into the broader economy? This flowchart tracks a single transaction. Let's say the Fed buys $100,000 in bonds. That creates a brand new $100,000 deposit in Bank 1. Because of the system called fractional reserve banking, banks don't keep every dollar they receive in the vault. If the reserve requirement is 10%, Bank 1 safely locks away $10,000 and loans out the remaining $90,000. Following the arrows to the right, we see that $90,000 loan gets spent and eventually deposited into Bank 2. Bank 2 then keeps 10%, $9,000, and loans out the other $81,000. The cascade continues from bank to bank. Looking at the summary box on the right, we can calculate the maximum possible size of this cascade using the money multiplier formula. You just divide 1 by the reserve ratio. Here, 1 divided by 0.10 gives us a multiplier of 10. The Federal Reserve plants the initial seed money, but it relies on the lending behavior of commercial banks to multiply that seed into the massive forest of our broader money supply. On a textbook page, that multiplier is a perfect mathematical equation. But in the real world, the Fed cannot dictate the exact final money supply. First, the Fed cannot force banks to lend out all their available funds. During uncertain economic times, a bank might choose to hold on to extra cash out of caution, which stops the multiplication process dead in its tracks. Second, the Fed cannot force everyday people to deposit their money. If you decide to keep a stack of physical cash in your wallet, that money isn't sitting in a bank to be loaned out again. Because of these unpredictable human choices, cautious bankers holding reserves and people holding physical cash, the real-world money multiplier is always smaller and much less precise than the textbook formula. The Federal Reserve is powerful because it sets the foundational base, but they act as a steering wheel rather than a dictator. They set the direction and rely on everyday banks and people to actually row the economic boat forward. Keep these mechanics in mind as you study. Good luck on your Chapter 17 exams. This video is for educational purposes only.